Good to
All
see
right,
you.
everybody, we'll get kicked off. We've got our panelists ready to go. Very excited and thank you for joining us. This is just a quick kind of down and dirty touch base on home equity and what's going on. A lot of excitement in the home equity market with values kind of soaring through 21 and just this becoming a hotter market due to rates rising and things of that nature. So I asked some friends in the industry to pull up with me and kind of discuss. Ken and Jay, if you want to quickly introduce yourselves. Ken, kick us off.
Sure. Well, thanks for having Curinos and myself on. We certainly appreciate the opportunity to engage with everyone here. But for those that don't know me, Ken Flaherty, work with Curinos' home equity division and specifically supporting our consortium of clients that we work directly with in collecting their weekly and monthly origination and portfolio data. And we scoop back and to allow lenders to understand what's happening specifically within their markets and all of their geographic footprint, and really understanding like how can you use this data to be a better player in the market, to be more competitive and see really the temperature of the market on are we on the upswing or downswing of things. I leveraged this tool in a prior institution I was with. Therefore, coming to Curinos was a really easy transition for me to work with lenders now on that same playing field. Over to Jay.
I just want to point out, Ken had to say his name, Curinos, a few times because no one actually knows how to say it. So we appreciate you giving us that tidbit.
Jay Plum from Fifth Third, also a curious name, but not as interesting as Curinos. But I've been with Fifth Third for about 2 years now. I manage the mortgage and home equity divisions. Before that, I did something similar at Huntington Bank. And before that, I did something similar at Citizens Bank. All of that means that I'm pretty old and have been in the consumer lending and mortgage space for about 30 years. Based in Ohio, but with Fifth Third, our operations are nationwide. So glad to be here today.
Ken, Jay, appreciate it. And those don't know me, Josh Livingston, EVP over at Class Valuation. I have actually been here a little over a year. And prior to that, I spent 17 plus years in the exact same office here in Omaha, Nebraska, working with title and valuation services with a huge foundation and start in the home equity market. So Ken, Jay, appreciate you joining us. I did ask Ken, just because he's got such great information and data in the industry, to kind of throw a deck together. And for those that know me, it's mostly because I don't ever allow to put PowerPoints together. So Ken, we'll turn it over to you to navigate, but there's some really great, interesting points. And as always, Jay and I will interrupt you when we find something intriguing. So turn it over to you.
Sounds good. And to further that point, although the general audience line, I believe, is all muted, but please feel free to leverage the chat. We're all going to be monitoring that. We want to really leverage this as more of a roundtable and getting your feedback and thoughts that we'll share as that comes up. So please feel free to utilize that. In thinking about this and the way to kind of set this up and get everyone talking and getting Jay and Josh's perspective on things, we thought one way to look at this is just kind of looking at this from a what's favorable for home equity, what's the outlook. I think the term I've heard probably more times than not over the course of this short part of 23 is a cautious yet optimistic outlook for home equity for this year. And really, home equity had such a great banner year in 2022 simply because of the rate environment dynamic just shifting so severely upward. Now you have millions of homeowners that are now going into a rate preservation mode, saying, I'm locked into a 2 or 3 handle on my first. Why would it make sense for me to do a cash out refinance again to tap into the growing equity in my home and disrupt that? Which is why we saw second lien HELOCs and HE loans grow tremendously last year, which we'll get to some slides and have some conversation around that. But as we think of what's on tap for 23, we're going to see a lot of the same with the rate movement, the persistent higher rate environment and forecast. But also the other piece of that is HPI, so home price appreciation and the home price index. We're going to see something that we haven't seen in a number of years, which is some declines in certain markets and probably more severe in other markets as compared to others. But for the most part, there's a ton of equity sitting out on borrowers' homes that's available for home equity usage. The challenge is going to be, and we just saw the tail end of last year, although the rate environment has helped home equity thrive, we're now hitting a point where rates went up so severely and still projected to go up a couple of basis points throughout the first part of this year. We're still going to see an environment where home equity is still dominant from the cash out space, but we're now hitting a point where homeowners are now second guessing or perhaps putting off some of those purchases as we are starting to see a bit of deceleration on that home equity growth. And I thought one way to help frame this up is to pull in some information directly from Fannie Mae. They put a really great housing forecast and economic forecast every month. So if we look at the latest from December, if we just pay attention to a couple of these metrics here, we'll first look at the rate environment, so where we were in 22, and then where we're projected for 23. So we're still projected to be around the north of 6 range for 23. But not only that, although we'll see what's projected to be some relief on rates for mortgage as we head into 24, we're still going to be in a space which, again, is going to be reflective of 22, where you still are sitting in a very big pocket of homeowners. Really, does 5 and 8, does 5.5 make sense for me to redo my entire first if I'm sitting at 2 3/4 or 3% on my first mortgage? So that's certainly going to continue to help home equity. As I talked about with HPI, that's also projected to kind of be on the downward slope. As you see here, for the first time in a number of quarters, we're going to start to see some HPI declines, but just given these double-digit growth numbers that we saw in 22, so in Q1 of 20, where we saw 20% HPI growth, you have to understand that that's not sustainable and that's not expected. So a bit of retreat is likely, which can give a lot of fear to a lot of lenders and a lot of homeowners with a declining market. But as we look at this next slide, as we borrowed from Black Knight, you have to look at just how much growth there was in 20 all the way through 22, just that huge uptick in the available equity in homeowners. So at the tail end of last year, Black Knight reported out that there's $11.5 trillion in available equity in the market. So if we see pockets of 1 to 5% decline in HPI, we're still talking a very robust market in terms of available equity and equity growth that homeowners experienced over the last few years. So let me pause there. Jay or Josh, any comments as we think about what this means for home equity in terms of a headwind or a tailwind for home equity growth?
Yeah, no, I mean, from my perspective, it's super interesting. And I get asked all the time, you know, what are markets doing? How should we prepare? Are we in a declining market, a rising market, a stable market? And, you know, it's difficult to answer because markets, you know, you look at, for example, the Phoenix market, there are pockets within it that are probably having some contraction, but there are pockets that are still very hot, heavy, and growing. So it's very difficult from a valuation standpoint to distinctly state, well, this is what's broadly happening for you. And I would say, though, even though we may see a generalization like in the last slide around some decline, as a whole, as this slide indicates, there's just so much growth that even a little bit of decline is still not going to have huge impact, I think, to the available market that is out there for lenders.
I think there are a couple of ways to think about this, as well as the rate forecast. In terms of the rate forecast, most customers are going to take a look at that 3%, 3.5% first mortgage and be very reluctant to get a cash out at 5.5 or above, even though in some cases that does make sense for them. I think the interest-only payment or the minimal payment requirements of HELOCs still make it an attractive debt instrument for most folks. And of course, if they have any desire to do a home improvement project, it's a much more efficient transaction than any unsecured option, even if that was just a portion of the proceeds. And folks who are at the low fixed mortgage rate at some point are still going to want to redo the bathroom and or add the deck or do some of the projects that would have been done with a cash out in prior years, but will be done by a home equity. As we look at the appreciation, we see a couple of opportunities. First, there likely are from folks who had refinanced even as recently as 21, some equity opportunities in their loans, definitely from earlier periods. And then second, we see some opportunities not to worry a huge amount. If we do see a 10% reduction, which is what a lot of folks are forecasting for national price levels on homes, a lot of that's concentrated on the coasts, but 10% takes us back to a level that's just a couple years old. So from a portfolio health standpoint, we don't necessarily have a big portfolio issue to deal with in terms of strategic defaults and other things because of a decline. We just have less equity in the property that isn't necessarily going to translate into a loss problem. Again, I would assume that you guys have taken a look at stuff like that. You probably feel the same way. Is that right?
Yeah, absolutely. And part of our consortium where we collect monthly portfolio snapshots, just looking at refresh loan to values, we're certainly not seeing any signs of portfolio stress. And in fact, delinquencies continue to decline as the economy is still relatively strong as we speak today. We have some headwinds facing us, but things are still looking very positive for lenders, which again, just to reinforce that cautious outlook, cautious but optimistic outlook of we hear things of perhaps challenging times coming ahead, but as of right now, portfolio health seems very favorable.
I would add one last thing to that portfolio health equation is that when we do think about declines in the available equity, the difference with that versus in the prior cycles is that folks are at a 3% note rate on their first. So they've tackled the affordability issue already, and they're in a much better shape to endure shocks. Now, if somebody loses their job, that's a risk, just like it's always a risk. But the consumer and the home equity portfolios are really well positioned from all the other financings that have gone on the past few years. So the customers who are applying for home equities are super strong, and the portfolios are poised to be resilient.
Well said, Jay. So I'm going to use that as a segue to move on here, to my earlier point on portfolio health. One measure that we take a look at is looking at utilization. So this is Josh's favorite topic that we'll dive into, but utilization is a bit of a head scratcher, at least from the outside, whereas we're seeing continued declines in utilization. But one key metric to look at in portfolio health when doing proper portfolio management is really looking at the different credit segments within your portfolio and what pockets are you seeing start to have higher utilization. Because historically, what generally happens is you see pockets of utilization spike during challenging times, higher unemployment rates. You'll start to see those spike, and then later you will see the defaults. It doesn't happen, the customer defaults, and then they get shut off. They generally draw down the line before they ever become severely delinquent. So to add on to that, we're still seeing positive signs from that angle, but as we think about utilization as a whole, this is still something that lenders continue to struggle with, and we continue to see struggling utilization, in specifically out of some of the more recent vintage years from 2020 onward. So as we look forward here, I'm going to take 30 seconds just to talk about this crazy slide with a ton of data on it. But what this is looking at, again, this is using Curinos' proprietary consortium data that we collect every month, and we're measuring average line size dating back by reporting year and vintage year, then we look at the average balances and the equation of what that means for utilization. So what this slide is looking at is all three of those metrics. Your black bar is going to, within our consortium, this is looking at the average market average line amount, so your commitment size. So from 2015 onward, you see just a kind of a straight line upward, where we started at average line sizes at 106,000 back in 2015. And then as HPI continued to grow and home equity became more at the forefront, you see a pretty steep upward curve here, 2020 through 22. And as we sit for 22, sitting in portfolios, the average line size has grown to just over 125,000. So that might be great from an origination standpoint, because that helps fuel your origination dollars. The point being is borrower sentiment continues to decline in terms of how they use their home as a cash out vehicle or as a piggy bank, because the average balance that we're seeing has declined during that same time frame. Back in 2015, the gray bar represents the average balance. So you can see just north of 50,000. And over the course of 7 years, it's the complete opposite. We're starting to see average balances shrink. So just over 45,000 is where we are present day sitting on books. As a result, it's not just we're seeing higher line sizes and flat usage, we're seeing the opposite effect. Therefore, you see a much steeper decline in average utilization rates, where we sit now all in average utilization sitting at about 30% for average lenders on books. So Josh, let me get your kind of thoughts and take here. I know you've been wanting to ask this question, is what the heck is going on? Hopefully this spells out a little bit more what's actually happening, but what other thoughts or comments do you have around that?
No, you're spot on. What the heck is going on? Right? There's more value in homes than we've ever seen. Where the lenders are coming out, or the borrowers are coming out to lenders saying, "Hey, I need larger lines of credit." But at the end of the day, not only are they drawing less from a dollar amount, but if you're looking at, that just translates to less utilization. And I don't want to speak for Jay, but I can't imagine as a lender, that's very exciting news to see that you're committing out more dollars, but less is being actually taken, because there's costs associated with all this and the various products and work and effort and monitoring it. And I'm trying to just understand too, with basically everything else in the world has gone up in cost and price, but from a home equity standpoint, is it still borrower sentiment that they're scared to tap into their house from equity aspects of it, or they fear decline? And it's not, as you can look and appreciate you going back all the way to 2015. It's interesting too, because this isn't a pandemic aspect of things where people were hovering back. This has been going on prior to that, and it's continuing on now that we're getting to endemic type situation. So I'm curious, Jay, what are you experiencing from your side? Because this slide makes, it spells it out pretty clearly, but it still confuses me in the sense of what the heck's going on.
Yeah, it definitely means that our vendor costs are too high, particularly our valuation costs. We'll have to chat about that after this call. Obviously a very big concern. I don't know how worried I am about this. It'd be nice if it was more than 45. I wish it was consistent at 45. It's not. If you broke this out in more tranches, you would see a greater disparity. I think some of this is influenced by bank sales practices. There are some banks that, when you waive the annual fee, the sales pitch in the branch is get a home equity as an insurance policy for when something bad happens, you'll be ready to go. Okay, that's an all right pitch to the customer, except that's a heck of a lot of origination costs that's not being offset with balances. Then there are the phenomenon of some of the pricing tiers give incentives to larger loan sizes if the customer has the available equity. That creates a false impression number on the usage rate, because the customer had never really needed the 100 grand, they're happy to get it, but they always knew that they were going to be using 50%. So whether it was a $70,000 line or a $100,000 line, they were only going to use the 50 grand. I think if you add in some of those phenomenon, the number is a little bit more balanced, but it is remarkable that given the price point of home equities, people would not use this more as opposed to a credit card. Because even home equities granted now at a higher rate are significantly cheaper than credit cards. That's probably a solicitation right now. So I gotta get that.
Thanks, Jay. Thanks, Josh. Yeah, so this has, when we talk to our clients, I mean, this is really seems to be one of the big head scratching moments as to how do we correct this. And I think Jay hit the nail on the head is if you have a sales execution method that's incenting more on just driving line size or just getting focus on how much can I get the most bang for your buck with less focus on balance, it's no question, this is exactly the results that you're going to see is you're going to see higher line size, higher growth. Therefore, you're going to hit your origination targets a little bit more easily. But from a unit perspective, you're not hitting the mark. And certainly from an average balance size, if you're not seeking balances and opportunities for debt consolidation, making that more the forefront, you're going to see a lack in balances. But go ahead.
Could I add one more thing, Ken?
Yeah.
You know, I do think traditional bank versus non-bank, there's some separation in the market that is worth noting. First off, every organization needs to have a usage strategy. It's not one and done with home equity lines of credit. It's one and then remind the customer quite often that they have the availability of the line. It is remarkable to me how many times at a number of institutions we ran a usage campaign where we just sent out checks, not even checks with promo rates. And we saw a lift in usage overall because the customer basically had forgotten that they had the availability of the line of credit. Second, I think all of us would be well served to think about how non-banks have changed the sales process and proactively have asked for the business. Every bank said they did it, but when you look at some of the packages that have come out from non-banks, they're doing a much better job of asking to consolidate debts for usage at the time of origination. Perhaps because that loan is going to be sold later and they need the usage up front to get the premium. But whatever it is, those salespeople are definitely proactively asking for the rest of the customer's business and using the new line as an opportunity for consolidation in a more aggressive way than some banks have done it in the past.
Yep.
Aggressive in a good way, not a nerve-wracking way.
Great points there, Jay, that it doesn't stop once the loan sells. It's a continued life cycle. One thing that maybe further that point, just to kind of show you a quick snapshot of what we've been measuring and helping clients with is this right here, just to walk you through. It's kind of a 3-point exercise. Again, kind of the bold headline here of originations are back, but performance still lags, just like we saw in that other trend line on usage rates. But as we think about the data we collect as a whole from the servicing platforms, we kind of look at this in the scope of, what's your origination strategy? Is it more in line with focusing on balances or selling insurance policy, rainy day HELOCs? So as we look at this isn't just a one or two lender thing. This is an industry-wide challenge. So the way to walk through this is in 3 points. So starting down here, this is looking at in terms of balances and of HELOC units sitting on books today. Over 70% of all open HELOCs have an active balance of $50,000 or less. So that pretty much jives with what we saw at that average $45,000 mark with 22 on the previous slide. So that's looking at those sitting at zero balance, right? So that's our point number 3 that I'll skip to. That's 37% of HELOCs sitting on books have yet to take a single draw. So think of that of a third of your book booked at zero and have remained at zero for that entirety of its lifespan. And again, that's collecting vintages all the way back to 2010 that we look at. That's just a lot of dough sitting on the table. That how much usage programs or activation programs are you targeting that customer to remind them that you didn't take a draw today, but you can still take a draw for the next 5 years, 7 years, however long they have in their draw period. And then to compound that, we look at that and we'll cover point number 2, which is just over 20% of open HELOC units have a credit line of $50,000 or less. So this really is kind of a mismatch of how much do we give the borrower versus their actual needs. So I kind of look at that as the adverse of 78.8%, so 79% of HELOC units sitting on books have an average line size of greater than $50,000. But as we come back down here, the actual balance, you have 70% of your book has a balance of less than 50,000. So it's obviously a mismatch of identifying the actual needs of the borrower, what consolidation and balance opportunities do you have to drive the book when almost 80% of your originations and HELOCs sitting on books have an excess line size. So just maybe an alternative way to think about as we think about of that sales strategy or sales execution or just ongoing lifespan of that HELOC, of that true opportunity isn't just today, it's for the next 10 years or however long that draw period lasts. So Jay started to go down a path here that was a really great segue that we'll lean into is the additional fragmentation that the home equity market as a whole has experienced of new lenders, call them fintechs, non-banks, IMBs now entering this market, now tapping into a very robust home equity market. One quick stat that I'll throw out that I don't have here that I just thought of, Curinos just did a annual home equity survey to all of our consortium clients that actively submit their data every week, which is about 40 plus lenders that participate in that consortium. And we did a survey and asking them, do you consider fintechs and non-banks that have just been introduced in the space a competitor? And the resounding answer was no, not really, or kind of indifferent to it. I look at this as really just we're scraping the iceberg with these fintechs. So as Jay kind of alluded to earlier, when you think about what are the big perks of a HELOC, why would a customer use a HELOC as opposed to a cash out? Those HELOCs, with a lot of them offering extreme payment flexibility, with many lenders offering interest-only payments during the draw period, you're not going to get any greater payment flexibility than that. The challenge is, and you think about how much business these non-banks and fintechs are actually doing in the market is pretty remarkable, and they continue to grow and more continue to add to the market. But it's really the convenience that they offer of kind of knocking off more of the more conventional bank and credit union lenders that average 30, 40, 50-day cycle times. They're able to do in a handful of days. But the alternative to that is they're giving up some of those perks and features that Jay mentioned on HELOCs of why would someone use a HELOC for payment flexibility. You have a fully amortized rate with a lot of these lenders that require 100% full fund at the time that they close. So they're getting around that piece of non-utilized HELOCs while at the same time taking away some of those perks with a fully amortized payment, but simply because they make it faster, easier, and more presentable for the customer. So Josh or Jay, anyone want to take a stab or further comment there of just how serious should we take these fintechs and non-banks as they start to take more of a hold in the home equity market?
I think as you look at the home equity market, it evolves. It's in cycles. It's a matter of our organizations committed to it for the long term. some organizations are, some aren't, but it's a traditional bank product where banks tend to always be involved. They might trim their offerings, but they usually don't exit. As I think about some of these competitors, yeah, they're going to be serious competitors in the market, but it's a different series of economics for the customer, and I'm not sure the customer is competing home equity to home equity as much as they may be competing home equity to unsecured product. So with some of these firms, I can compete, and some I can't. So why would I say something like that? Well, going beyond price for a minute and just thinking about process, I can't get super fast at certain price points because I'm going to have to get a appraisal that meets the interagency guidance on valuations that my regulator insists that I enforce and adhere to. That guidance, which came out in 2010 and really reshaped how we use AVMs and other valuations. Josh, I don't know, but you might know something about this. Well, we'll see. Not every organization on this page has to adhere to that kind of a standard. That does mean that it's difficult for them to sell their loans to banks, or they have to go through another step or two to get there. For us, we'll use that interagency guidance to have a cascade of different valuations that sometimes will mean that we're a lot slower than some of these other guys. And if that's important to the customer that they need their funds quickly, they're going to select one of these guys or go unsecured, and they're not going to select us.
Yeah, no, thanks, Jade. And like to that point around speed, valuation can be the long pole in the tent and can be a challenge. And the key is building out a solution that meets your regulator guidelines, your investor guidelines, if you're a fintech side, all of those things. And it can be a challenge, right? AVMs are going to be, anybody that's able to use an AVM can do it faster than someone that's going to have to use a traditional 1004. That's given, right? And having the cascade from that to a qualitative desktop that is utilized does make home equity a challenge and competing on a fair level. Because even in the banking world, one regulator, from an OCC regulator to a Fed to a state regulator can have difference of opinion and how they view the risk and what's important to you. So it always poses challenges, but that's why Jay, you call me and we'll build out solutions that work at Class and make it a process for you.
Just to clarify, you guys are in the valuation business, is that correct?
We are in all levels of the valuation business.
Yeah, okay.
AVM through 1004 and everything in between.
So there are some situations where it's not just the FIREA level that gets you to a 1004, but generally speaking in home equity land, we're trying to use AVMs as often as we can. We think alternative valuations are pretty good, and we like them, but there are some times where we can't use the kind of valuations that would lead to even faster speed. And that's when competition with organizations like this that might have a different regulatory construct become a little challenging. And having the right partner who can help us figure out which tools to use when is critical. It's not just the AVM cascade, but it's the entire spectrum of valuation tools to maximize customer service as well as cost, and identify what points on the credit spectrum each product is optimized for. And in our experience, as long as you can explain that cascade to a regulator, you can have a lot more effective use of valuation tools than if you assume that they know exactly what you're doing. It's more than a traditional valuation of an AVM and an AVM cascade. It's the entire picture of loan size, credit score, a variety of LTV and lien position, all in a coherent conversation.
Jay, that's an interesting point too about not only explaining to the regulator, but also explaining to your borrower. We have individuals out there that, AVM would pass all standards within the lending community, but the borrower wants the traditional 1004. It's a pride of ownership of their home, and they want to see, and they're in their mind. Some of that is just understanding out there, but I would advise anyone too that's jumping into the home equity market. Your LOs can be really aggressive, as Jay mentioned earlier, in selling, but helping them to understand why they're doing what they're doing and what matters, what can be best, or being able to answer the questions around those products. Get good vendor partners that can help you. That's in title, that's in valuation, that's in everything. They should be able to assist and guide that borrower through that process as well.
So, Josh, I want to come back on this topic and ask one other question, but there's a question in the chat that maybe Josh and or Jay can comment on that I was saving for this segment from Kenneth, strong name there. Can the panel offer any insight on the type and mix of valuation products that lenders rely upon for home equity products? I think we touched on that a little bit, and in the data we collect, we are starting to see a much stronger wave, in particular in 21 and 22, of more AVM usage based upon the appraisal type used. But anything further there that you can elaborate on in terms of the mix and what we're seeing out there?
Yeah, my old friend Ken, it's good to see he's sending questions my way that make it easy for me. But no, it's building out that complete cascading solution that takes all those factors in of your investor, your compliance, internal compliance, your external regulators, and ensuring that everyone understands there's costs associated with it, there's speed associated with it. And any good provider, if you don't have one class, I'm more than happy to help, but any good provider can break those down. And it is truly a mix of qualitative interior and exterior desktops. And desktop's a weird name and nomenclature in the valuation business, because that's now applied to the first mortgage business more than it ever has before. So this is a hybrid desktop that involves typically a broker or an agent capturing imagery of the home on the exterior and pairing it with a geocompetent local appraiser to make the determination opine on value. And on the AVM side, there's great solutions out there across the board with cascading solutions. It's funny, as I remember when AVMs first came out, like people would get requests for waterfalls of like 8 or 9 deep, and you're kind of like, if you're getting to the 9th AVM, you've got challenges, right? Leave it to 1, 2. If you want to get crazy, maybe have a 3, but also look at where those AVMs are really effective at. There's AVMs that are really strong in certain parts of the country, certain areas, and we have some really competent lenders out there that actually go down to the county level, which AVM they use, based off of partners out there like Black Knight and AVM Metrics that offer a lot of insight into hit rates and quality in those areas. So there's a lot out there. And then to expand upon that, when you go to a 1004, as we know, with some of the information people are dipping into first mortgages, we've seen a lot of discussions in first mortgage around hybrid and digital appraisals. I personally think that really applies in a great way to the home equity space as well. When a 1004 is needed, why aren't you using a digital appraisal? You'll have a better history and data set than you've ever had before. And if you're portfolioing that loan or your investors accept it, it's a faster, cleaner process and has huge lift and results across the board.
Yep. Great. Thanks, Josh. Thanks, Ken, for the question. I want to spend maybe 2 more minutes on this topic before we move on, but I'm curious to get the thoughts from the audience here. So again, class participation is helpful. So throw your questions or comments there in the chat. But Jay, let me direct this question to you. So as we think about and everything we've talked about with these new lenders, these new fintechs and non-banks entering this space, you made the point earlier is, what draws a customer, to choose one of these, whereas if I was shopping for a HELOC today, I'm not necessarily calling to see what's your cycle time, how fast can you get it to me? Just really, what is your opinion on what's drawing customers that might be doing, might have their deposits at your institution, but are electing to go with one of these lenders, other than maybe just the obvious of just the good old fashioned, really effective marketing? I mean, I think not a month goes by that I get some sort of solicitation from one or a number of one of these lenders named here of their HELOC solutions and tapping into the equity into my home, come use us. Any thoughts that you can share around that?
We would say two things. And, it's the same two things that come up all the time in virtually every business setting. It's marketing and service. So when you can turn around a customer request in 3 days and the customer is already in the middle of doing that bathroom remodel and realize that they want to upgrade all the different things that they were going to put in there, it matters to them to get the access to the money quickly. And some of the folks on this page can do that better than banks can. It's not too far removed that banks were doing, a majority of banks were doing turnaround time of home equity requests in 60 days. Consumers want money faster than that. They've been conditioned that way from the unsecured market. So I think it's important to realize that service never goes out of style, and taking the customer's interest to heart is a big deal. I also think because of the regulatory situation for some of these organizations, they've had more flexibility to experiment with data and technology than some of the banks have. A lot of the banks still run on antiquated systems. I know we do. And while we have gotten more hamsters to run on the wheel, it still has a limitation about how fast it can go because it's a 25-year-old system. Until we upgrade it, we can't take advantage of some of the data that's available now in the market that can speed the decisioning process dramatically. But if you're one of these firms and you just built your system, you've got some key built-in advantages. As it relates to marketing, getting the word out always matters. And while we do have an installed customer base of branch customers, we're probably not as effective at digital marketing as some of the firms on this page. And that's allowed them to gain a foothold and really excel at talking to the customer. I think that's changing. I think the playing field is getting more balanced as folks say that it's great that we have a branch in banking land, but we need to reach out to the customer wherever they are with messages that are more compelling and messages that are a little bit more informative. So I think those two things combined create some pressure for banks to keep up and not just rely on traditional branch sales methods.
Great feedback, Jay. Appreciate that. So let's use that as a great segue. We must have talked before, Jay, because we're leading right in to kind of this next topic here, which is everybody's favorite, whether you like the results or not, is cycle time, just the challenges that continue to persist. So again, this is collected using Curinos' origination data that we collect weekly from lenders. So this is looking back to Q1 of 20, all the way forward through year end of last year. So as we follow this, you look at HELOC is the black line, HE loans, first and second, is going to be the bluish colored line here. So you can kind of see where we started. HE loans really gripped the market in terms of market offerings, and a lot of lenders focusing on that first lien HE loan product as an alternative to cash out refinance, really swelled pipelines. A lot of lenders shifted resources from their equity business to mortgage, which challenged fulfillment times and so on. But as you look, we've made progress on both HELOCs and HE loans. But as you see it today, what's interesting is towards the tail end of Q3, I'm sorry, the start of Q3 into Q4, HE loans are actually cycling faster than HELOCs now, but we're still deadlocked in this north of 50 days, 51 days on average is what it takes a customer to get the same product or a similar product that they're getting to some of these other institutions. So I think this kind of leads way into kind of what Jay's coming from is, service is still key. That's still very important to customers, especially as home improvement still top of mind for them. Large purchase transactions, debt consolidation, that's still in the forefront, but their actual execution and how they do that isn't that desirable from the home equity offering space. So before I open up any comments or questions here from Jay and Josh, I'll add in this page here as we think about just what have lenders done to help transform themselves to be have more of a feel for a digital experience. And we have some cycle time showing here that we'll look at, but the main impact is really looking at this shift that the industry has seen from more of a less dependent outlook on using branches to drive originations, although that's still the majority. We're seeing that huge spike in recent quarters of more lenders now leveraging more bolt-on front-end products like Blend and Roostify, now using that as the digital platform. So if you follow this kind of bottom chart here that's highlighted with these values, that's going to be the percentage of centralized origination. So that's going to be mainly your digital and .com type of originations. So if we start at pre-pandemic, 30.2%, so just under a third of originations through the centralized network, and then boom, we see the pandemic hit, and now we surged up to 38% in Q2 of 2020, and then came back down a little bit. And then really from there, we kind of merged out of this COVID surge of everyone trying to figure out how to keep the home equity wagon going, of now immediately shifting to digital. But now we're coming into this time frame where more lenders are shifting their origination strategy to more of a digital adoption. So as you see kind of in this time frame here, surging upwards, and we have consecutive quarters for the last 6 or so quarters where we ended last year that we're touching almost 50% of originations now being done through a digital source as opposed to the standard brick and mortar decentralized branch. So as we think about that, we're heading in the right direction as an industry, but at the same time, we continue to see more sustained, more flat line on our cycle times and the service delivery to customers for a similar product of what's offered out there. To further on Jay's point before, this again puts into context, it's not just the fintech providers providing home equities, but this also puts personal lending and unsecured products more in the focus of being a direct competitor. Is, hey, if I have a one-time usage and I can get a personal loan in a couple of hours or a handful of days, that might not be the product that I truly desired, but if I can do it in a fraction of the time through maybe a fintech or just getting a personal loan, this is most certainly going to shift customers to a better experience, but not necessarily the desired outcome from a product standpoint. So let me open it up. Who wants to start, Jay or Josh, to further on those comments?
Well, Ken and I know each other for a long time, and I once commented on his turnaround time in his department not being optimal. But I think we can say in a general way that these turn times just don't make sense given how much available is, or how much data is now available electronically. When I think back to 2005-06, when the firm I was with was just getting on LendingTree, we were using an AVM, and we were using title products that were alternative title products that had warranties. If the customer had all the information, we were getting loans closed in 48 hours. They were supplying their pay stubs, and we were going through the file really fast because the data was available really quickly. Now, that was only happening on 20 to 30% of the total applications that came in the door, but they were the ones who wanted a fast service. So they were ready. They were ready to go. They could send in their deck page. They could send in their pay stub, and we were ready. Post-Dodd-Frank, you now have to have a PCR with that AVM, and that condition report is necessarily going to delay it a bit. But the availability of all that information electronically is much more advanced and much cheaper than it was even just a couple of years ago. So I think you're going to see all of these trends change as folks become much more comfortable with the availability of information digitally to put into the process. It's not just having the data available, it's being able to have computer systems that can use the data and change the process. Our turn times here at Fifth Third were amongst some of the worst in the country. They're not now because service always matters. Part of that is getting data faster, but part of it is also making a commitment that it doesn't make any sense why it takes 40 days to get a home equity done.
Yeah. The other thing I'll throw in here that this chart shows us, Jay, is as more lenders start taking on, whether it was forced or welcomed, to kind of push themselves into more of a digital platform, making it easier for customers, helping with that overall front end experience. We couldn't help but notice in some of specifically looking at pull-through metrics, and the same persist on cycle times. If you follow these lines here across the trend line, the purple line represents the decentralized pull-through rate. So this is measuring the applications that come through the door versus the bookings that come that result from those original applications. And we couldn't help but notice just how wide that delta was when you compare the two customer paths that you can take, is going into a branch or going through a digital platform. Is the pull-through rates just over time and have just done nothing but widen in terms of pull-through rates in branches as compared to the digital channel. So as you see here, leveraging Q3 data, which we feel is the most seasoned data, average pull-through rates for your more centralized, more digital type of platforms is 35%, as opposed to your more brick and mortar branches that have more of the handhold. I've got a bit more vested interest because that's my customer I took the application for. We're seeing north of 46% pull-through. So still not ideal in terms of overall pull-through, but Jay or Josh, any sense for what's your thoughts as to why, just because we moved to digital, that's actually worsening the effect on our pipeline efficiency?
They're just more shoppers. So you have to create a process that accommodates that. It's as if it was a bank doing a lot of direct mail. Direct mail customers are going to close at a lower rate. It's going to mess up the percentage, but it's totally explainable as long as your marketing acquisition cost works. So same thing with digital. The lower closing ratio is okay if your cost to acquire the customer is reasonable.
Yep, agreed. I'll make one final comment on that, then we have a question in the chat that we'll get to. But as we think about that digital adoption, again, it really comes in two folds. And a lot of Curinos, we have a OSX team and digital operations team that kind of look at lenders that are leveraging more digital platforms. What does that experience look like between lenders? And one thing that's pretty clear is when you adopt a digital path for your customers to go through, that it doesn't stop there. It doesn't mean that you get a bolt on to the front, you get a clean front end to make an atmosphere that looks really slick and they can load all their docs through a portal and so on. It's the secondhand effect of how much are you shifting your fulfillment teams and your fulfillment processes to leverage that same platform, because many times what we see and hear directly from our clients is, we got the front end, so that's great. So we have a .com, we have a digital tool, we have an app that they can apply through, but our fulfillment processes didn't change. We're still reliant upon branches to get us all the documentation. We're still reliant upon someone making a phone call for a customer to provide those documentation, and they're not leveraging the full ability of these digital opportunities to get a customer digitally from start to close, where you may not actually have to talk to a customer every single week or every single day. We could just send notifications, please load docs here, and then the fulfillment team goes and grabs those without actually having to make direct contact or relying upon branches to make time out of their day to go hunt those documents down. So we definitely see that as a huge opportunity, as kind of that secondhand effect as more lenders moving into this space, but being sure to connect those dots with your fulfillment teams.
Ken, I'd add to that, and just two aspects of it. One, I'm curious to see what this looks this time next year.
Yeah.
As I really think that the point of sales, Blend, First Close, Roostify, all of these guys out there have really spent more time focusing in the last couple months around home equity, just because it's a need, where before everything was all things mortgage, first mortgage related. So I think we'll see this continue to refine. But the one thing I remind everybody in that aspect of it, though, is, and Jay touched on this around service being king, is it's great that your system does those automated notifications. Hey, you need to send me this, you need to send me that. I still will say, though, nothing substitutes picking up the phone if you want to close a transaction. So having a SWAT team that if something starts to slow down or go off the rails or delays, how are you approaching that borrower, and how are you reaching out to them and connecting with them beyond just another text message or another email, and strategizing around that? And it's a very effective way to get a lot of stuff going, and having it at your fingertips does appeal to someone like me who's running around crazy all the time. But at the same time too, if I have a question, I need to be able to talk to somebody. And if I'm falling off the wagon and not responding to you, you're gonna have to pick up the phone and motivate me to come back around.
That's right. Thanks, Josh. We're coming to a close here, but there was a question in chat we wanted to be sure to get to. One item, if you could touch on CLTV, what is the sweet spot for HELOCs and home equity loans? Based on what we see on the data we collect, even though the line sizes and the average loan amounts on HE loans has continued to grow, as we kind of mentioned earlier, lenders are still sticking in that less than 60% space. And in fact, if memory serves, the originations in total for 22, it was north of 50%, were less than 60%, despite the higher average line size. And I think that's a direct result of higher HPI growth and more equity in borrowers' homes. So I would definitely say less than 60 is definitely the sweet spot, with the next piece at 70%. And I think a lot of that is dictated by lenders, whether it's their pricing strategy or different credit box cutoffs. But 60 to 70 is probably the next closest, but still playing in that very space, CLTV space, between 60 and 70%. Jay or Josh, anything further to add on that one?
The only thing I would add is that we see a lot of competitors going up to 90, very few at 100, and most below 90, like 80 or 85. But the customer has enough equity to bring it down to those numbers that Ken was talking about. I think as long as credit policies are tiered and reflect the added risk of less collateral coverage, home equity is a advantageous product for both the customer and the bank at a variety of LTV levels.
Yep, agreed. All right, I know we're over time. Josh, you want to wrap this up?
Yeah, no, thank you everybody for attending and sharing any side of your insight through the question bank. Jay, Ken, again, as always, pleasure was all on this side, no doubt in my mind. So looking forward to doing this in person. I think the next major home equity event is a CBA in March, and hopefully we can all connect face to face versus via Zoom. And appreciate your time today. If anyone has any questions, don't hesitate to reach out.
Thanks.
Thanks, everyone.
Thanks, everybody.